So the question is, how do we estimate that $25,000? And we have a couple choices. The first one is to base it on sales. So if you base it on sales, again, you just look at the history of the company. Normally you come up with company policy on what seems reasonable. So you don't have to use the same thing every year, but you need to come up with something with some kind of support because the auditors will question you on that percentage. Let's say that we have a beginning balance in the allowance for doubtful accounts of $10,000. I'm going to go down here to this little T account. And again, the allowance account's a contra asset. So if an asset has a debit balance, a contra asset has a credit balance. So this thing has to go over here. You have $500,000 in sales this year and $300,000 in accounts receivable. Past history says normally you have 5% of sales that you have to write off. And write off is another way of saying they default. There's a whole, those of you old enough to remember Seinfeld, there's one where Kramer says, the company's going to write it off. And Jerry says, what's write off means? I don't know, but the company does. So that's what a write-off means. It means you're defaulting and we know you're going to default. But again, we don't really know which customers are going to do it. We just say on average, 5% do. So you would take your sales, multiply it by what your estimate is. And one thing we'll learn in this chapter and beyond is there's a lot of things on the financial statements that are estimates. All of the numbers aren't true and verifiable. They're estimates of what we think might happen. And we do that again because we really want your financials to show what you think the expected future economic benefits and sacrifices are. So it's not the for certains, it's the estimated. The accounts we use will always be the same when we make this entry. So we're going to have bad debt expense and allowance for doubtful accounts. Always those two accounts. Don't ever change those around. And I didn't give myself enough room. And that's where the 25,000 came from. So when we're done, I had 10,000 here. Because I made sales this year, I've got 25,000 in extra expense that goes into this year. So my allowance for doubtful accounts, assuming nothing else went on, the allowance is 35. So of your total accounts receivable, we would have our 300. Let me put my balance sheet over here. I would have my accounts receivable of 300. I take out my allowance of 35. So the total amount that I have for net accounts receivable is 265. So that's basing it on sales. You come up with a percent of, for every $100 of sales that you make, you think $5 won't be collected. Our other choice, and this is kind of an income statement approach because we're looking at the income statement and we're making sure that our 25,000 expense matches that 500 in a reasonable way. Our other choices kind of look at the receivables side. This is basically more of a balance sheet approach. And here what we want to look at is if we look at our specific accounts, kind of that goes back to that subsidiary journal. Who and what do we think is uncollectible? What we usually do is just come up with some general rules, and we do what's called an aging of the receivables. And that means you set up categories for, how long it's been an account receivable. And again, we're going to just estimate the percentage not collected. Assuming, you have like 210 net 30, most people will pay in the 30 days. Once you get out to 2, 3, 4 months, those are more likely to default. That's what we do with the aging. We do what's called an age trial balance. And this is kind of a different way to use the word trial balance than what we did in the early chapters. I can ask senior accounting majors, what's an age trial balance? And they'll come up with something silly. But all an age trial balance is you break up your accounts receivable into some categories. And I did these particular ones. Companies will do it differently depending on what their credit terms are and what their experience is. It's 210 net 30, probably most of them are going to pay. We'll say 1% of those are going to go bad. This is 2 and 3 months. A little bit more of those aren't going to pay. 5 months out, more of them are going to default. And then we're saying 60% of that 10,000 is not going to pay out. To figure out how much is going to default, we just multiply this and this. So that means $1,500 are going to default. Maybe. It's 36. So we think 3,600 of those is 12.5. I only think 4,000 of those are going to pay. You add that up and you come up with an estimate. Every problem will be different. Every category will be different, but the process will be the same. That part's the easy part. This is the part you have to understand. This is saying of the accounts receivable, this should be your uncollectible. That should be your allowance for uncollectible because we've looked at everything and that's what we think it should be. If we look at our account down here, our allowance for bad debts, we think that number should be 23.6. We had 10,000 left over from last year that we started with. This was our beginning balance. That's this number right here. So this is our beginning. This number is giving you the ending balance. What we need to solve for is what goes here. This is where those T accounts that you went through in boot camp really come in handy. And I always, after I do this, I double check. So 0 plus 6 is 6, and this is 3, that's 23. This is our journal entry. And you're asking me, why do we have to do that here? And we didn't have to do that on sales. Sure, you're asking me that. The reason is, here I'm looking my accounts receivable and seeing how much of my total should be uncollectible. The net really should be this minus this. That should be my net on my balance sheet. Over here, I'm looking at the income statement. I'm looking at my sales, and I say, well, sales are 500. This year's expense should be in the same year as this year's sales. So I'm looking at sales to figure out what that expense should be this year. I don't care about the beginning balance because that was the percentage from last year's sales. So again, the difference between the method is with sales, what you solve for, your estimate equals the expense, which should make sense because that's an income statement account, that's an income statement account. With your accounts receivable, your estimate equals what the allowance account should be. Put ending balance. They're both estimates. They're both reasonable estimates, but they're different estimates, and you'll never get the same answer. The presentation on the balance sheet, we always put our accounts receivable. We subtract out the allowance. That gives you your accounts receivable net or net accounts receivable. Percent of sales, the accounts receivable stays the same. That's in your general ledger. So that was 275. With accounts receivable aging, we had 23.6. So that was 276. Different numbers because, again, different estimates. Pros and cons, as we said, all are just estimates. So that's not pro or con, that's just a statement of fact. For the percent of sales, kind of the income statement is, let me put better. With the receivables method, your balance sheet is probably a little better. And another thing we'll see over time is that's a trade-off FASB has to make all the time is, do we want your income statement to be more spot on or your balance sheet? And there's no right answer. So a lot of times they'll allow you to do either. Seems to me, again, especially with that aging, that is probably, in my opinion, better estimate of the future economic benefits of your asset. For percent of sales, it's easy. And sometimes easy is fine, especially if it's not materially different. There's nothing wrong with doing something because it's easy. Again, the rule to remember is the one we just had before. For sales, you make the entry for that amount that you solve for. For accounts receivable, you have to do that T account to find the journal entry. These other entries, regardless of which method you use to estimate, you're going to do exactly the same thing. And even on the adjusting journal entry, notice the accounts are always the same. It's the amount that you have to work on. The question is, let's say Toys R Us went out of business, as you well know maybe. Let's say they owe you $1,000. They go out of business, so now I'm going to write off their account. This is not the adjusting journal entry anymore. This is when someone defaults. What has to go away? Remember, the bad debt expense gets closed every year, so you don't want to mess with that anymore. That got closed last year. So this allowance account has to change. We got to reduce that. They don't owe us any money anymore, so the account receivable has to go down. We have to reduce, and we need to reduce that allowance account. I always start with the easy one. To reduce an account receivable, I credit it. Hopefully, you know, and this is like one of those triple negatives. So to reduce a contra account, this would normally have a credit balance. So to reduce it, I have to debit it. What isn't affected, not bad debt expense. And you're going to want to do it. And as soon as you do it, open this page and say, not. That's the whole point of the allowance. We really expense this in the year of the sale. Our balance sheet, before the write-off, we had accounts receivable, $300,000. Let's pick that allowance of 25. Doubtful accounts. Allowance for doubtful accounts, we'll say that's the 25. And that gave us our net of 275. Must be getting tired. And I'm just pulling that from up here at the beginning. After I make this journal entry, my accounts receivable goes down by 1,000. So that's 299 now. This allowance goes down by 1,000. So that's 24,000. And I've got 275. Point is that 275 here and there, that's the amount that I think is the future economic benefit, the amount that I'm going to eventually collect. So before the write-off and after the write-off, I still expect to collect 275. As I write things off, it just reduces my allowance because now there's only 24,000 more that I think might default. Well, the question is, what happens if somebody ends up paying you? So we're going to say Toys R Us goes through bankruptcy and they end up not paying us 1,000, but 600 as ordered by the court. All we want to do is basically undo what we did before. So we want to, we call it reverse this entry, just means flip it, do the opposite, but just for the $600 that they actually are going to pay us. We're going to put it back into accounts receivable, and we're going to put it back into this allowance for doubtful accounts, but just for the 600 that we are going to get. And then once we're there, we're back to where we were before, and then we just collect a receivable like we always did. We're going to get cash, we're going to get accounts receivable, And always do this in 2 entries, even though you can see the accounts receivable kind of cancels each other out. Otherwise, you'll do it wrong. So when the account is reinstated, what is not booked? And again, there is no expense account, no bad debt expense, because we expense this in the year we sold stuff to Toys R Us. We don't expense it when they default. That means the only time that you make an entry to bad debt expense is in that year-end adjusting journal entry. So that one adjusting entry is the only time. This is one of the few times where I can say there's no exceptions. The only time you make an entry to debit bad debt expense. When in doubt, pick another account.